Now we turn to cost. We'll explain some of the cost concept and cost behaviors. There are different kinds of cost. There are different classification of cost, and sometimes people consider certain costs are non-existing or superficial. So we are going to investigate that too, and then we'll see how cost influence our economic decision. So cost can be classified in many different ways. If we think of costs that we see in financial statements, basically costs can be divided into two types. One is period cost, within the period. That is the cost that match the revenue on a time period. Okay, we'll come to that. Or if you see the example here, expenses over a period of time. It doesn't come from anything specific. But on the other hand, there's another type of cost. It's called product cost. Okay. Product costs come from mainly products. So if you look at the financial statement, in balance sheet, there's inventory. The inventory is considered as product cost because it's made of products, right? Made of those material and relevant issues, and resulting the product and become inventory. And it corresponds to the income statement. The cost will be the cost of goods sold. So this inventory, this cost of the product will become cost of the product against the revenue from the product. So a lot of analysis will involve these two. A lot of costs are related to the product that we are creating and trying to sell. A lot of other costs will be related to the time. Okay, the expenses that incurred during a specific period of time. Let's just use the ice cream shop as an example. Here we see that we are selling ice cream. Okay, and the ice cream cost, right? Ice cream by itself is cost. The materials, cream, sugar, milk, and milk solids. The unit cost is 0.65. The cone, whatever cone, sugar cone, or waffle cone, or paper cone, I guess. These are the materials. It's $0.05. And the wages, which is related to the product itself, and supply utility. These are all directly related to the products, so they are part of product cost. And we rent the place. The place is used for many different purposes. We pay tax, we have sales tax, we have payroll tax, we have business tax, we have debt service that we pay, and other insurance, advertisement, and so on. Those are period costs. Those things incurred for the period. Okay, maybe it's also by month, it's by year, but basically they incurred. You don't have that kind of things directly related to a number of products or changing with the products. So these are the two types of the costs which are commonly seen. And if it's product cost, then we can associate the cost with the number of product. Otherwise, we are just dealing with all the costs within the period that incurred the cost. There's also different kinds of classification. which is so-called fixed cost or variable cost. Okay. Before that, there is something called volume index. Volume index. Volume index is we want to know the volume. We want to measure the volume. However, we need to have a metric to define the volume. Then we count the numbers against that volume. There are some examples. For example, we will look at automobile. We'll look at the mile driven, right? The mile. Every mile that you drive, and there will be some cost incurred. Or generating power generation plant, a kilowatt hour produced. Or stamping machine, every part you stamp, then you get a parts, but you also get the cost. Also, I just mentioned that there, in terms of cost behavior, there's fixed cost. There could be variable cost. Of course, they can be a mixed cost. Fixed cost is just happen periodically. Like you bought the machine. The machine is a fixed cost. Every 3 months, you need to do certain things. Then that could be considered a fixed cost because it's not directly related to the number of items you produced. However, there are a lot of things related to number of items or the number of product you produce. The more you produce, the higher cost it will be. For example, materials of the product. The more you produce, the material cost will be higher. The more you produce, the more labor cost is going to incur. Right? So these are different, very basic but different types of costs, and some products have this fixed cost and variable cost together, which you can understand. You do have that, and there's also a very important concept on average unit cost. So when you say that the cost is high or low, we are looking at the number. However, it depends on the volume. You have you spend a certain amount of the money driving from one location to another location. You talk about the number, which seems to be quite big, but if you consider the miles that you have driven, then the unit cost could be very low. So a lot of times when we are comparing the cost, we need to look at the unit cost, so that we understand the implication of the cost on the product that we are going to produce and sell. So fixed cost, as you can see, that is just from the beginning to the end is just the same. It doesn't increase unless there's another reason that it goes up and stay the same for a long time, right? And basically, the simplest form is just fix at the number. And variable cost, as the volume increased, the cost increase. So the more you produce, the higher the cost is. That is the variable cost. And again, the average unit cost, if you have fixed costs and variable costs together, you can imagine that variable costs grow linearly with the number of items that you have, but the fixed cost shared by the volume, so per unit cost, will, as the volume increase, the per unit fixed cost shared by the units will continue to decrease. So you can imagine that there's a line, linear line, growing as number increase, but there's a fixed cost line decrease as number of the item increase. So they present different behavior, and chances are there's this break-even analysis that will analyze for this kind of situation. Let's look at an example so that it can be more clear on what we meant by fixed cost and variable cost. Here, assuming that we purchase a car, so we own a car, and there will be costs associated simply by owning the car. On the other hand, whenever you use the car, there will be additional costs incurred due to the usage. So, owning the car, if we see the table here, by owning the car, you have to buy insurance. I think even if you don't want to buy insurance, there are some mandatory regulation by different countries that you have to at least protect others rather than yourself. But anyway, just in case that you want to buy an insurance called comprehensive insurance that covers pretty much everything, but you have to pay for the first $250 before the insurance company will cover the rest. That insurance fee will cover a year, a whole period, and if it's a rental car, which is a different situation, it covers the period you are using the car. Okay. And there's also collision and damage. There's a liability. So these are different kinds of auto insurance that you have to get for your car over the period of usually a year. Doesn't matter you drive the car or not. You purchase the insurance, the cost will be there. Also for the car, you have to have license. You do this license and registration. You have to pay for that, for your license plate and for your registration. And that is just once a year. And you have to pay for the tax. So these costs, they are not the cost for the car when you purchase it. It's the cost where you need to spend every year, but it is independent to how much you use the car. Okay. So these are considered as fixed costs, but it's an annual fixed cost. On the other hand, when you own the car, when you start to drive the car, there will be additional costs incurred because driving car require, or car movement require fuel, and also there are some other oils that you have to have in order to make the car function properly. So these two will be dependent on how much you drive. The more you drive, the more fuel you will consume. So the cost will be higher. So it depends on how much you drive or how many mileage that you drive. Similarly, the more you drive, okay, after you accumulate to certain usage, you have to maintain the car. It could be 5,000 miles, could be longer, could be shorter. But once you reach that mileage, you have to get it maintained. That will be a cost. So if you consider the needs of maintenance, it depends on the mileage that you drive. So it is a variable cost. Similarly, every time you drive the car, I think here we can see that it's about the tires. You will have some depreciation on the tire. In fact, you have some depreciation on the brakes too, and you have a depreciation on a lot of other parts which are harder to detect. Maybe we can consider all of them lump sum together within the maintenance. But tire is something very direct. Right? Your tire is in contact with the road surface, so it will depreciate, and the depreciation rate can be seen there with conversion to the price of the tire. So that we can calculate. So for every mile that you drive, there will be costs associated with that. For owning the car over the course of a year, there will be some cost associated that regardless the mileage that you drove the car. There will be also something maybe not directly related. It's more like you have the car, and the car will get older and less functional and so on. It could be later we'll come back to this. It could be functional depreciation, it could be accounting book depreciation and so on. But just think of functional depreciation, right? You have a car. After 10 years, you may need to replace the car. So every year there will be some depreciation. But the depreciation, okay, there will be some depreciation every year. However, the depreciation will get faster if you drive the car more. So the more mileages you drive the car, the higher depreciation you will incur. So one part is every year allowing car to sit there not doing anything. There's a cost associated with that, and the more you drive, the more depreciation you will incur. So it's a mixture of fixed cost and variable cost. If we summarize the data from the previous slide, we can have this table. Assuming that within a year, if we are driving, say, only 5,000 miles during that year, or 10,000 or 15,000 or 20,000, it will reflect different unit costs. We'll see later how that happens. But let's look at the cost structure here. So we know that doesn't matter how much mileage that you drove, and each mile there will be a variable cost which is computed from the previous data from the previous slide. So depending on how the mileage that you drove, it will multiply the mileage by the unit variable cost. Okay, so the more you drove, the higher cost it will be. There's also something called mixed cost. Remember that is for depreciation. So there's also a variable cost, variable portion. So we sort of divided them into something like this. Fixed part will still be fixed, but variable portion will depending again how many miles that you drove. So it will vary. And for the car, there's a fixed cost part, registration, license, insurance, and so on. The total cost will be fixed. So these are the costs relevant to each instance of mileages, like 5,000 to 20,000. And if we divided the total cost by number of miles, the result will be, as you can see here, which is probably, if you think of it carefully, you can probably figure out what happened. That is, when you drove less, okay, then your variable cost is less. However, variable costs stay the same for the units. For the fixed cost, it is a fixed amount. Then if you drive it more, then the fixed cost will be shared by more units of the miles. So per unit cost becomes smaller. So with the fixed cost, the per unit cost becomes smaller. So you add them together, since the variable costs are the same, and the fixed cost lower for higher mileage, and it is higher for lower mileage. So it is reflected here, as you can see. For 5,000 miles that you drove within a year, your cost per mile is close to $1. But if you drove for 20,000 miles, then the unit cost becomes only 0.36 or to 0.37. It's a lot lower. Okay, that is considered the cost per mile for the EV vehicle. So you can use this idea or this concept to think of if you want to have a car, and what is the cost of owning a car versus taking public transportation. From this example, you can probably tell that it really depends on how far you need to travel every day. Like if you travel far every day, then the unit cost will be a lot lower. Comparing with public transportation, then it's probably more viable or more attractive to buy a car. Versus if you only travel a very short distance to work, by owning a car, you have very high fixed costs shared by very few mileages. So for every miles that you travel, the cost will be a lot higher. Then you may want to take public transportation rather than owning a car. This change of the unit cost for fixed costs can be shown by this diagram. If you look at the solid curve represents the unit cost, the fixed cost of the unit cost for driving. If you look at x-axis, there's 5,000, 10,000, 15,000, and 20,000 miles. So they have different unit costs under different mileage driven in 1 year. Added by the same variable cost, right? Variable cost is a unit cost. It stays the same. Doesn't matter how many miles that you drive. The unit cost will still be, the variable unit cost will still be the same. So all the fixed costs unit will be added with this identical variable cost. So the dotted curve represents the unit cost, the total unit cost per mile for different mileage of driving that you had over the course of a year. And as you can see that in this case, as the miles increase or as the mileage increase, the total unit cost decrease. Okay, it can be further illustrated with these figures.